Welcome to Knockout Crypto. Thank you for following the channel. Don't forget to subscribe to the channel. Click like on the video. Subscribe to the channel. I really appreciate you guys' help and support of the channel. So the IRS just issued its first cryptocurrency tax guidance in 5 years. This is big news because we've been looking for some sort of regulation from the IRS and the SEC, but the IRS has issued some cryptocurrency tax guidance for 5 years, which means that they acknowledge cryptocurrency as a source of income that needs to be taxed. So let's get on to this article. The U.S. Internal Revenue Service, IRS, has published its first guidance in 5 years for calculating taxes on cryptocurrency holdings. Industry members have been eagerly awaiting the update since May 2019, when IRS Commissioner Charles Rettig said the agency was working on providing fresh guidance. The agency's 2014 guidance left many questions unanswered, and the crypto market has grown more complex in the years since. As expected, the guidance notice last Wednesday addresses the tax liabilities created by cryptocurrency forks, the acceptable methods for valuing cryptocurrency received as income, and how to calculate taxable gains when selling cryptocurrencies. Drew Henske, a lawyer with Carlton Fields and the general counsel to Athena blockchain, told Coinbase that from the tax collector standpoint, this is the right answer. Though certified public accounting Phillips said he was surprised that the guidance basically only addressed forks. Resolving a long-standing question, the guidance says new cryptocurrencies created from a fork of an existing blockchain should be treated as ordinary income equal to the fair market value of the new cryptocurrency when it was received. In other words, tax liabilities will apply when the new cryptocurrencies are recorded on the blockchain if a taxpayer actually has control over the coins and can spend them. The document reads, if your cryptocurrency went through a hard fork, but you did not receive any new cryptocurrency, whether through an airdrop, a distribution of cryptocurrency to multiple taxpayers distributed ledger addresses, or some kind of transfer, you don't have taxable income. James Mascarero, a partner at Evershed Sutherland, told Coindesk that this applies when there is a distinctly different cryptocurrency as a result of the hard fork. The IRS language might create more confusion, said Jay Brito, executive director at Coin Center. While the new guidance offers some much needed clarity on certain questions related to calculating bases, gains, and losses, it seems confused about the nature of hard forks and airdrops, Brito told Coindesk. One unfortunate consequence of this guidance is that third parties can now create tax reporting obligations for you by simply forking a network whose coins you own or foisting on you an unwanted airdrop. Individuals would be assessed income when they receive the asset. Receipt is defined by dominion and control, so its ability to transfer, sell, exchange, or dispose of the asset according to this guidance, he said. The fear is that someone maliciously airdrops and tags you with a giant liability, but this fear is a bit oversold because you will only be liable for new income based on fair market value of the asset when received, and most folks don't start out with a high valuation. Phillips said it's possible that an individual with an Ethereum wallet, for example, could receive an ERC20 token from an airdrop without realizing it. Depending on how the token's value fluctuate, this may result in them having to pay income tax on an asset that was worth more when they received it than when they sell the asset. This can happen when coins hit a high watermark or price discovery right after the airdrop event, and then the heavy selling could sink to the price to a level from which it never recovers, he said. The issue has grown more salient in recent years as fights over protocol changes cause rift in various crypto communities, leading to a split of currencies like Ethereum Classic and Bitcoin Cash. Holders of the original Bitcoin and Ethereum could automatically claim a like amount of new coins, raising the question of whether and under what conditions they would owe taxes on the windfall. Now, crypto holders and their accountants have a roadmap. The new IRS cost basis. The new IRS document also offers longer-rated clarification on how taxpayers can determine the cost basis or fair market value of coins received as income, such as from mining or the sale of goods and services. Cost basis should be calculated by summing up all the money spent to acquire the crypto, including fees, commissions, and other acquisition costs in US dollars. A third key issue addressed by the new IRS guidance is how to determine the cost basis of each unit of cryptocurrency that is disposed of in a taxable transaction, such as a sale. This is an issue because someone might buy Bitcoin in multiple transactions over a span of years. When they sold some of it, it was unclear which purchase price to use for calculating taxable gains. The value of crypto purchased on the exchange is determined by the amount of the exchange sold it for in US dollars. The income basis in this case will include commissions, fees, and other costs of the purchase. If the crypto is bought on a peer-to-peer exchange or a DEX, it is possible to use a crypto price index to determine the fair market value. In the words of the IRS, this can be a cryptocurrency or blockchain explorer that analyzes worldwide indices of a cryptocurrency and calculates the value of the cryptocurrency at the exact date and time. When selling crypto, taxpayers can identify the coins they are disposing of either by documenting the specific unit unique digital identifiers such as a private key, public key, and address, or by record showing the transaction information for all units in a single account or address the IRS vote. This information in the document states must show the date and time each unit was acquired, your basis and the fair market value of each unit at the time it was acquired, the date and time each unit was sold, exchanged, or otherwise disposed of, the fair market value of each unit when sold, exchanged, or disposed of, and the amount of the money or the value of the property received for each unit. The new guidance allows first in, first out accounting or specifically identifying when the cryptocurrencies being sold were acquired. Let's say I bought my first unit at $5,000 and my second unit at $2,000 and I sold one of my units. I can identify the unit or I can use first in, first out, he said. From a tax planning perspective, you may want to be specific about which unit you sold or may want to use a first in, first out because sometimes you want a capital gain and sometimes you might want a loss. Other issues, and they disappointed the crypto users who like to spend their coins on everyday purchases like cups of coffee. The IRS specifically said they would not create an exemption for transactions below a certain threshold. Paying somebody for a service will result in a capital gain or loss, which should be calculated as the difference between the fair market value of the services you received and your adjusted basis in the virtual currency exchange. Purchases of goods and services were deemed taxable when the IRS issued its original guidance in 2014, which said that digital currencies were to be treated as property rather than currency for tax purposes. This discouraged casual spending and made tax season burdensome for users who want to diligently report their obligations. I think this is the key line. Digital currency were to be treated as property rather than currency for tax purposes. Treated as property rather than currency for tax purposes. That was in 2004. So that is what they're going on, and so that's where we are. The IRS has issued some new cryptocurrency tax guidance in 5 years. This guidance is really just talking about the forks and how do you handle taxes on cryptocurrency forks, basically. If you understood the article I was just reading. Guys, thank you for following Knockout Crypto. You can find us on Instagram, Twitter, and YouTube. Thank you for supporting the channel. Don't forget to join us at knockoutcrypto.com to get the next big crypto report and to also get trading alerts, okay? Thank you for following Knockout Crypto.
In a world of when Lambo, crypto scams, and fake projects, where can you find true value? No time to research cryptocurrency projects. No money for crypto reports that cost thousands and thousands of dollars. Don't feel defeated. Knockout Crypto Reports are the answer. Knockout Crypto Reports does the research, saving you time. Knockout Crypto Reports are affordable, saving you money. Knockout Crypto Reports only include the highest quality reports. If you want that Lambo, you need to learn how to invest in the highest quality projects early. Knockout Crypto Reports identifies the highest quality projects early, making you money and saving you time. Go to knockoutcrypto.com and sign up for the report now.